Back in 2008, nobody thought anything was wrong. People were buying houses they couldn't afford. Banks were giving out loans like it was free money. The stock market kept going up, and up, and up. And for a while, it worked. Everyone felt smart. Everyone felt safe. Everyone thought the system was stable. Until one day, it wasn't. The cracks didn't appear all at once. They showed up slowly, quietly, in places most people weren't looking. A missed payment here. A default there. A company quietly going under. But nobody paid attention. Because everything still looked fine. And that's the dangerous part. Because when things look fine, that's usually when they're not. Today, in 2026, something feels off again. Not obvious. Not dramatic. Just off. The kind of feeling you can't explain. But you can't ignore either. It's in the way prices keep rising. Even when people can't afford them. It's in the way debt keeps growing. Like nobody plans to pay it back. It's in the way markets react. Like risk doesn't exist anymore. And if you've been paying attention, you've probably felt it too. That quiet tension. That subtle feeling that something isn't adding up. Because when you step back and look at the bigger picture, you start to notice patterns. And patterns don't lie. Before every major financial crisis, there were signs. Not loud warnings. Not breaking news headlines. Just small, repeating signals. Signals that most people ignored. In 2008, it was housing. Before that, it was the dot-com bubble. And every time, the story was the same. Prices went up too fast. People took on too much risk. And eventually, reality caught up. Right now, we're seeing those same signals again. But this time, they're everywhere. Housing prices in many areas are still out of reach for the average person. Rent is climbing faster than incomes. Credit card debt is hitting record levels. And yet, people keep spending. Not because they want to, but because they have to. Because the cost of living isn't slowing down. And when people start relying on debt just to survive, that's not growth. That's pressure. At the same time, markets are behaving like nothing can go wrong. Stocks recover quickly after every dip. Investors buy the fear, over and over again. And the idea that this time is different, starts to sound convincing. But it's always convincing. Right before it isn't. No higher authority exists. Which means the central bank sits at the center of the entire financial plumbing network. Quietly ensuring that the pipes keep flowing. But the pipes don't only move money. They move risk. And sometimes, that risk travels faster than anyone expects. To see how quickly things can unravel, go back to 2008. During the global financial crisis, something unusual happened. Banks suddenly stopped trusting each other. Not publicly, but inside the system. Short-term lending markets, where banks normally borrow from each other overnight, began to freeze. Institutions worried that the bank on the other side of a trade might collapse before repayment. So they stopped lending. And when lending stopped, liquidity vanished. The pipes were still there. But the water stopped flowing. Central banks stepped in immediately. They injected enormous amounts of liquidity into financial markets. They guaranteed loans. They created emergency programs. All designed to restore trust in the invisible system that moves money. Without those interventions, the global financial network might have seized up completely. And when that network freezes, the real economy quickly follows. Factories can't finance operations. Companies miss payroll. Trade slows. Economic activity contracts. The financial plumbing may be invisible, but its failure becomes visible very quickly. Now here's the uncomfortable part. The system works largely because participants believe it works. Trust is the foundation. Every bank assumes other banks will honor payments. Every clearinghouse assumes collateral will cover losses. Every investor assumes markets will remain liquid. Most of the time, these assumptions hold. But occasionally, reality pushes back. Financial history is filled with moments where confidence disappeared almost overnight. And when that happens, even well-designed systems come under pressure. The irony is that modern finance has become incredibly efficient at moving money. Faster than ever. Across more markets. With more participants. Technology made this possible. Trading algorithms. Instant communication. Global networks. But speed introduces its own problems. When trillions move every day, small disruptions can scale quickly. A software glitch. A cyber attack. A sudden market panic. Right now, we're at a point where things could go either way. Maybe the system adjusts. Maybe things stabilize. Maybe nothing major happens. Or maybe this is the calm before something bigger. And the truth is, nobody knows for sure. But uncertainty itself is a signal. A reminder that things aren't as predictable as they seem. So instead of asking, is a crash coming? Maybe the better question is, what are we missing? Because the biggest risks are usually the ones nobody talks about. The ones hidden beneath normal headlines. The ones buried under short-term optimism. And if something really is building, it won't announce itself. It'll show up quietly. In data. In behavior. In patterns. Just like before. So maybe nothing happens. Maybe 2026 turns out fine. But maybe this feeling isn't random. Maybe it's the same feeling people had before. They just didn't recognize it yet. And if that's true, then the real danger isn't what's coming next. It's thinking that nothing is. Because that's exactly how it looked last time.